want to welcome everybody to the CECL seminar this morning, Current Expected Credit Loss. And we're today going to cover current status and next steps for financial institutions. So welcome on behalf of CRI. Our presenter today, I'm actually the moderator, but our presenter, we're pleased to have Doug Mims with CRI. He's one of our lead banking partners, actually started our banking practice in the Carr Ingram office of Montgomery some 20 years ago. He's currently our financial institutions industry line leader and just does a lot for the firm relative to financial institutions. Doug has over 25 years of experience providing assurance and advisory services to banks, both private and publicly traded banks. And we're just pleased to have him as a presenter today. He's made numerous presentations relative to this topic and other topics that are of interest to financial institutions. So we're pleased to have Doug Mims as our presenter today. And again, I'm Phyllis Ingram. I'm the partner in charge of our Montgomery office. I'm also the industry line leader for financial services, which includes insurance and financial institutions. And I'm one of the founding members of Carr Ingram some 22 years ago. So I'm pleased to be the moderator today. So with that, Doug, I'll turn it over to you to go over the agenda and really the webinar. Thank you.
Also, just quick from a housekeeping standpoint, we do have the guidelines for qualifying for CPE. And, you have to be in attendance the entire webinar and answer all the poll questions. So we'll have, I think, 4 or 5 poll questions during that. So just make sure you answer the questions. We want you to get your CPE. And then you can see the other references there. Qualified attendees will receive a CPE certificate for an hour within 24 hours of the webinar. And if you have any issues, email our marketing department. So just a little bit.
Thank you, Doug. I failed to mention that.
No problem. And be on the lookout for the poll questions though, because if you don't answer those, you don't get the CPE. And we'll keep saying that so you don't forget. So today's agenda, some of you participated in what we call CECL 1. This is CECL 2. It's where are we today and where are we going essentially. And so I'm going to cover some of the basics of CECL, some of the theoretical stuff. And maybe drill down just a little bit. Last time was a broader view. I'm going to drill down a little bit in some of the areas, and we're going to stick to loans. CECL impacts investments in some other areas, but we're not going to venture off there. We're going to stick with loans. We're going to dig a little bit into historical losses, qualitative adjustments, reasonable and supportable forecasts, touch on reversion. And then we're going to talk about the weighted average remaining maturity method and then next steps. So we're going to try to be a little bit practical about how we go about it. The 50 minutes or an hour is not a lot of time to go into these topics. So we'll keep it high level, but hopefully give you an idea of maybe some things you've been looking at, struggling with, or if you're just getting started, maybe it'll be a good overview for you. So where are we? Just to give you a little background on CECL, which most of you probably already know, the initial exposure draft, believe it or not, was issued in 2010, and the revised exposure draft was issued in 2012. So that's when the things started moving. It took quite a while. At that time, the number of comment letters received on the CECL standard, if you will, on what is now ASU 2016-13, the number of comment letters was the most in the history of the FASB. I don't know if that's still true or not, but it received a lot of feedback. And if you're keeping up with the news and reading your email and the things that you see, it still gets a lot of discussion. So it took a while to get to the final standard. And when the final standard was issued, the initial effective date for all SEC registrants was Q1 of 2020. Non-public companies was Q1 of 21, and private companies was Q1 of 21. Now, since then, there was an additional pushback to basically move it to Q1 2022, which is kind of where we were sitting up until yesterday. So, in July, the FASB voted for a proposal for large accelerated SEC filers to still have the Q1 220 deadline, but for everybody else, and there's no cutting and slicing and dicing, who's a PBE, who's not, who's a private company, all that confusing stuff that people were struggling with, where do I fit in? Basically, if you're not a large accelerated SEC filer, everybody else is Q1 of 2023. So they moved the timeline out significantly from where we started. Now, that may not seem like a lot of time at this juncture, but it obviously is a lot more than we had. For large accelerated filers, no reprieve there. So absent legislation, which is being talked about, absent legislation coming out of Washington, I think Q1 220, we're going to have the Bank of Americas and other folks that aren't on this call will have to be effective with CECL. So I had the opportunity to attend the AICPA annual Bank and Savings Institutions annual meeting. This was last month, and it's a great, always a lot of information, a lot of folks that interact with and network with and discuss various topics. So we send a group of people, and typically I think we had a half dozen there this time, but there was a lot of CECL, as you might imagine, and probably 7 or 8 sessions on CECL. So I tried to attend all those. Some of them conflicted, but I tried to garner all that information and bring it here in a condensed format. But one of the things that a couple of next slides were things that I derived from some of the information. So this is a recent poll, and I'm assuming this doesn't include large accelerated filers, because if any of those folks recently polled and are in this position, then they're going to have a problem. So I'm assuming this is everybody else. And so recent poll, 19% of financial institutions or banks specifically haven't started yet. 29% are in the process of selecting or creating a model for implementation. 32% are developing the internal controls and processes around their internal or externally developed model. 2% are finished, and 18% are unknown. So if you look at that, that means 98% of the respondents are still working on it. And I'm assuming the folks on this call are some of that 98%, and that's why you're tuning in. So I think there's a lot of folks in the same place. There's still a lot of what I'll use the phrase or the description, smaller, less complex institutions, and that's derived from if you've tuned into any of the FDIC webinars and whatnot, they refer to smaller, less complex. And I'm assuming at this juncture you're not an accelerated filer. You're on this call because you fall in that other bucket, which means you're probably smaller and less complex. So we'll cut to the chase on some of this stuff and talk more practically after we get through the theory. We'll talk more practically about what you might be considering or should be considering. So where are we? Again, this is coming out of some of that information we garnered, kind of folks that have been through the process, and particularly those who thought they were going to have to comply sooner. A lot of folks actually went down the path that were PBEs or that were small SEC registrants. Non-accelerated filers had to go down the path. It was Q1 220 for them, so they go down the path and get a reprieve. Some of them were like, heck, I'd already done everything. I wish we would have gone ahead. So, but here's some of the challenges, resource challenges, which I know you're all probably grappling with now, internal, external, leveraging your trusted advisors, things of that nature. The smaller banks are considered to have the widest range of methodologies, and they still have gaps in understanding. Lots of institutions talking about looking at using models for the first time. And technically, our client base, a lot of our folks, while some have historically used third parties, a lot of them use spreadsheets. And a spreadsheet actually is a model, depending on how you treat it and how you use it. So, but a lot of our community banks wouldn't have used a sophisticated model in the past, possibly. So that creates some unique challenges. And then the other piece that I hear everywhere I go, everybody I talk to is data, and we'll talk more about that later. But are you going to have access to your data to rely upon it? So in the process of gaining an understanding internally with our firm, as well as seeking to educate our folks and to do things like this, I've kind of gone through, and we've gone through the process of identifying all the tools that are out there, all the resources that are out there, from whether it's AICPA, the American Bankers Association, the Independent Community Bankers Association, our state associations, the FASB, all these folks, all these places where we could get information. And so, practically speaking, for you, if you're going, hey, there's so much stuff out here, I don't even know where to start. I started reading this document. It's 100 pages. What am I going to do with it? So these are the things that I found most useful in getting through this process. So first of all, the actual standard, ASU 2016-18. Some of the things we'll talk about theoretically here today, those are included, the reference within the ASU is included in the slide. So if you choose to go back later and read the full context, get full context of the area, that's in the slide. The FFIEC webinars, now those webinars have included the FDIC, the OCC, the NCUA, the state bankers associations have been represented, FASB's been represented, and the SEC's been represented. So all relevant parties have been represented on these webinars. My recollection is each one is about 90 minutes, so obviously that'd be 4.5 hours, the better part of a day to spend listening to them. I don't know if you have that amount of time to invest or desire to invest it. I found it very useful, particularly early in the process. The FASB issued a Q&A on the weighted average remaining maturity method, which we're going to talk more about. That's a short document, very easy to get through. The FFIEC issued an FAQ. They actually issued it, and they've updated it at least once, if not twice. The latest update was April the 3rd. I think that'll be updated again when they issue the interagency guidance that I'll reference in a minute. That's a 43-page document. I've read the whole thing. I've yellow highlighted it. If you email me, I'll send it to you, and maybe you can use it as a Cliff Notes version and not read all 43 pages like I did. The Center for Audit Quality has a CECL tool for audit committees. Smaller, less complex institutions, that can be a useful tool for you. You might want to, I'll say, not dumb it down, but maybe simplify it, meaning there's probably more information in there than you would need. The American Bankers also has a CECL intro PowerPoint out on their website in their CECL section that you could use to talk to your boards. I'm not sure, depending on where your conversations have been, and whatnot, that might be a useful tool. The AICPA just issued a CECL practice aid for auditors. I'll talk more about that later, but it's fashioned as a audit tool, but that would be in the AICPA's view and the task force that prepared it. In their view, it would also be an excellent resource for those seeking to implement CECL, not just those who are looking to audit CECL. And that's hot off the press. That was literally issued in I think October actually. So pending FFIEC interagency guidance on CECL, that to me, that's for a smaller, less complex institution. That's what we're waiting for. We can talk theory, and we will. We can talk practicality, and we will. But the real practicality is, hey, what are we actually going to be expected to do by our regulators? Because unfortunately or unfortunately, that drives the lens that banks have, community banks have, and the lens that we have. And that's just the way that works, as you all know. So that document is in draft form. It's going through their form of an exposure draft, if you will. I think they've got another term for it. But I ran into a guy at the banking conference I mentioned, and he had done a presentation in Atlanta, and I said, hey, when's the guide coming? Because he referenced it in Atlanta. I think in May we were at the FDIC offices, and he said, hey man, it's out in comment, and it's coming. So I'm hoping it's coming before the end of the year. And when it comes, we'll go through it, and we'll be ready. We'll pull together CECL 3, and we'll go through that interagency guidance and cut to the chase with you on that. With that, I'll turn it over to Phyllis to do the first poll question to make sure you get your CPE credit.
Thank you, Doug. We have our first poll question, but I do want to remind everybody, and Doug probably mentioned this, but you do have to be logged on individually to get your CPE credit. You can't really be in a group in a conference room with one login, so just make sure you're logged on individually if you need to get the CPE credit. and you have to answer all 4 poll questions. They don't have to be right, but you have to answer them. So the first poll question is, CECL is applicable for the largest SEC restaurants in the 4th quarter of 2020. True or false? If you'll go ahead and click one of those answers now. Just got a few more seconds. We'll close the poll now. So the poll results are true. So Doug, you need to recover that. The answer is actually false.
Yeah, that's
Doug,
right.
you may want to hit on that again.
So most
poll
of you,
questions pretty easy too.
most of you are not large accelerated filers, and possibly none of you are. So it's the 1st quarter of 2020, not the 4th quarter. So as you know, SEC registrants file quarterly, and so theoretically 1/1 is the adoption date, implementation date, and when Q1 2020, when the Qs go out, CECL will be embedded in those documents. So it's Q1 of 2020. So everybody wake up for the next session. Thank you.
That was a trick question, Doug. You know, trick question.
Okay, so the macro on the allowance. So the allowance for credit losses. It's actually not the allowance for loan losses anymore. It's the allowance for credit losses. I guess we'll abbreviate it and call it ACL, but everybody's referred to the allowance for credit losses. There will be a valuation account, which is what we have now. It'll be deducted from the amortized cost basis of financial assets. It'll be used to present the net amount expected to be collected and the changes in that amount from period to period will flow through net income. Now, I don't know if I cover in here, I'm going to go ahead and say it. Initial adoption goes through retained earnings. It does not go through net income, and for regulatory purposes, you can bring it in over a 3-year period, I believe it is. But once you adopt CECL, all prospective changes must go through net income. So, but when it goes through capital, initially, obviously, it'll impact your regulatory capital. So what does that look like mechanically? So A would be your amortized cost and the unpaid principal balance of the loan. This adjusted for loan fees, net loan fees, origination expenses, repayments, write-offs, non-accrual practices, and certain hedging transactions. Smaller, less complex, probably hedging doesn't apply. It's the same way you present your loans now. So it's your net loan balance, not yet net of the allowance for or the allowance for credit losses. So C is the remaining amounts expected to be collected, and the difference is the allowance that you have calculated. So it's A plus B equals C. It's very similar to what we do today in theory, other than the way we go about getting to B is going to be different. So what's changing and what's not? So today, asset classes have required estimation methods. Pooling is permitted but not required, although most of the folks on this call probably pool by call code, and so but it's not required today. You actually don't have to. Recognize losses when probable. So the probable and estimable, the old FAS 5, which is ASC 450, the probable and estimable goes away. That's under CECL. It's not probable or inestimable. We'll talk about what it is, but it's not that anymore. So tomorrow there'll be a single impairment mode. Pooling is required when assets have similar risk characteristics, which could very well be your call codes. We'll talk about that a little bit more later. It will include reasonable and supportable forecasts. So we're looking forward, which with CECL, and no threshold to recognize losses, and that threshold it's referring to is probable and estimable. That again, that goes away. So what's not changing? There's no complex estimation models required for loans. So some of the things you've read about, I think there were 5 outlined in the ASU. So in some training somewhere, in some article, you may have seen those. Those 5 are acceptable but not required, and we'll talk specifically about the WARM method here in a few minutes. The fact that you consider past events and current conditions won't change. So now, if you're looking at your spreadsheet or however you're doing it, and you're thinking about your ASC 450 bucket, your old FAS 5 bucket, that bucket takes into account your historical losses, which is past events, and current conditions, which is your current qualitative factors. They're not prospective, they're current. But those 2 pieces are already in place, and we'll look mechanically how that is, what that looks like here in a couple of slides. And it requires judgment today, and it's going to require judgment in the future. So those things are not going to change. Those 3 things will remain the same. CECL theoretically only changes the timing of a loss, not the amount lost. So it's not going to change. It doesn't change what you ultimately charge off, and theoretically, it doesn't change the amount you're going to reserve. It just recognizes it sooner. Theoretically, that's CECL. So at the end of the day, when a loan goes from inception to payoff or charge off, however it occurs, from beginning to end, the losses you recognize for CECL will not be more or less than what you would recognize today. And I think that's a little bit of a misnomer. I think some folks think CECL means more loss recognition. It means you may have loss recognition sooner, but theoretically it would not be more. So this is obviously we borrowed this from the FASB and noted that as such, and there's several iterations they go through, the several scenarios that we could have pulled in, but I just wanted to pull in one to kind of give you the macro view and kind of break it down a little bit. So today, under current U.S. GAAP, you take your unadjusted historical charge-off experience, you adjust it for qualitative factors, which is what I was just mentioning. You multiply that times the loss emergence period. I won't get off on loss emergence period, but that won't really change that much. Right now, most folks aren't using that. Small, less complex banks, and then or they're not using it as it can be theoretically discussed. And then you multiply that times your loan category balance, which gives you the ASC 450 or your FAS 5 allowance for loan losses. That's the mechanics today. Only difference here is, so you look down and you go historical charge-off experience. Those are supposed to represent lifetime. Your qualitative adjustments will not just be current conditions, as you note in the first scenario. It will include current and forecasted. The loss emergence period will not be applicable, and you will multiply that times your loan category balance, which goes back to how you segment your loan portfolio, which again most likely would be by call code, and that will result in your CECL ACL. So just a little comparative there, and you have these slides to look back at that later if I went too fast or maybe I lost you there in translation. So we're going to do another poll question.
Okay, here we go. Our next poll question. Complex estimation methods are required under CECL. True or false? So we have a 50-50 chance of getting this one correct. And remember, you have to answer this question whether right or wrong. And we can't see who's answering right or wrong, so it doesn't matter. But you have to answer the question to get the CPE credit. So we'll keep the poll open for just a few seconds. And hopefully, Doug, you've done better on this topic. So we'll close the poll now, and we'll get the results. Okay, the group answered false, 73% false and 27% true. Oh, and we did good. That's the right answer. False is the right answer. So we got more than 50% Correct. So that's great. Thank you, Doug.
So complex models are not required. And that's important because smaller, less complex institutions don't need complex models. We need a simplified, scaled down solution. And so that's kind of where we're going to go from here in our discussion. So let's talk about historical credit loss information. What is that? And it's going to be it's a heck of a lot like what you have today. In fact, it's the same stuff. So when we say past events, we're talking about your historical loss data. And that data generally provides a basis for assessing expected credit losses. The standard does say that you shall consider adjusting it for the following differences. So if the current asset-specific risk characteristics, meaning within a pool, if you need to adjust your historical data because it's not representative of your current bank or the way you lend or the current environment, you would want to adjust it. You want to make adjustments for contractual term, which could be on an individual basis or pool basis, and you want to adjust that data for different economic conditions. So there are scenarios in which you would adjust your historical data. Common adjustments to this data would include changes in underwriting and historical losses from a different point in the credit cycle. I'll give you an example. So most of you, if you go back 3 or 5 years, most of our smaller, less complex banks, you really wouldn't get a different answer. I mean, it's been very similar in terms of losses. Luckily, not a whole lot over the last 3 to 5 years. And so you might not have to adjust your historical information in its raw form. But if you were an institution that came out of the downturn in particularly bad shape, and it took you a little while to work out of it, and you were continuing to work with problem credits and recognizing losses, if we went back 7 years, you might get a very different answer. I have one client that if you went back 7 or 10 years, you would get a completely different answer than if you go back 5. But not only have the losses changed, management has changed, governance has changed, and the way they make loans has changed, in addition to the fact the general economy has just gotten better and we're in a better environment. So that would be an instance in which you probably wouldn't go back all that way, but if you did, you would have to normalize that data for the current place the bank is in. So qualitative adjustments. If you read the interagency guidance, it tells you that the qualitative adjustment, and this is the Q&A that references back to the old interagency guidance. It says, hey, the qualitative adjustments are a whole lot like what we've been doing. And the ones that we have in our old interagency statement, they're probably going to be very similar when we have a new interagency statement. So it's not new. Qualitative adjustments are permitted under CECL to capture current conditions and reasonable and supportable forecasts. There is a potential that they will change both in the number and nature and magnitude. The qualitative adjustments might change. I think that the bar is going to be raised. I think there's going to be more focus on them than there was from your regulators. I would imagine that your regulators have looked at to see where your allowance has wound up and what your unallocated reserve is, and if all that looked good, you felt like you're probably going to be okay, and they probably didn't ask a whole lot of questions about your qualitative factors, and that's because they're looking at it from an examiner's view. Your pesky auditors like us might ask more questions about it, but I think that the bar is going to be raised, and so there's an opportunity here to enhance your documentation, even for those qualitative factors that will remain the same under CECL. So qualitative factors also identify information relevant to assessing the collectibility of cash flows. That information can be internal or external or a combination of both. And they make an emphasis to say that internal information may be sufficient and it may be more appropriate. That available information may relate to past events, current conditions, or reasonable and supportable forecasts. So qualitative adjustments are the same under CECL as they are today, with the exception, in terms of theoretically what they represent, with the exception of they do include forward-looking information. And it also, and actually, it says that's at the bottom of the slide. It includes the forward-looking information, but also you don't need to forecast factors that are not relevant. And that you might go, well, no kidding, but we don't have to do the kitchen sink. We need to identify the factors that are relevant. We'll leverage the FFIEC guidance when it comes out. In the meantime, I'll be leveraging the existing guidance. And you're looking at do I need to qualitatively adjust my past events? Do I need to qualitatively adjust for current conditions? And then what do I adjust for reasonable and supportable forecasts? So theoretically, that's qualitative adjustments. And those are designed to bridge the gap between loans in the current portfolio as of the reporting date and loans in the historical data. So it's your qualitative adjustments or your bridge between historical data and current conditions and events. So a couple of examples: the financial institution's historical losses reflect loans originated under stricter underwriting standards. Loans in the financial institution's current portfolio reflect loosened underwriting standards when compared with historical periods. And that kind of goes back to the example that I mentioned about a live example with a client. Their underwriting standards are different. Their strategic objectives are different. It's a different bank. If we went back to 7 years, we would need to adjust that data to normalize it because it doesn't represent that institution and what they do today, and it doesn't represent on a forward-looking basis what they will do. And with that, we will do another poll question.
Okay, this is our third poll question, and it is: qualitative adjustments are permitted under CECL, true or false? So we'll give you a few minutes to respond. Remember, you have to answer to receive CPE credit.
If you missed this, you know me and you're doing it on purpose.
Yeah, trying to get it right so Doug won't have bad reviews on his on his webinar skills. No, I'm just teasing. He won't get bad reviews, but we'll keep the poll open just for a couple more seconds. And so answer that true or false, and now we'll close the poll. Oh, good. The answer is true, and you'll see that the attendees voted 92% that it's true, 8% that's false, and that was probably some of Doug's clients that voted the 8% was false. So thank you, and Doug, we'll turn it back over to you.
Okay, thank you, Phyllis. So let's talk a little bit about reasonable and supportable forecasts, and I know we're very much in the theory, which is why we give you the slides so you can refer back to them. It's also why we give you the references in the FASB so you can refer back to those. They get a little bit hard to work through. So developing forecasts, you should consider relevant quantitative and qualitative information to assessing collectability. So this is forward-looking, developing forecasts. Relevant. That word is you see it repeatedly, and so no need to have the kitchen sink approach. We don't have to pull everything in, just the relevant quantitative and qualitative data. Information includes internal, external, or a combination. Past events, current conditions, and reasonable and supportable forecast. Not required to search all possible information that is not reasonably available, and you may find that internal information is sufficient. So there's a theme here of, is it relevant? Is it practical to obtain that information? And hey, you might have internal information that's sufficient. You don't have to go search, everywhere for this data. So there's a clear intent on the FASB's part, and in particular when you bring in the FFIEC Q&A, and I think we'll see in the guidance to make this practical for smaller, less complex institutions. Some other points: you're not required to develop forecast over the entire contractual term. You're not required to correlate or reconcile reasonable and supportable forecasts to macroeconomic data. And consider refining future estimates based on actual experience. So these are some things that these aren't necessarily in the standard. These are things, the feedback they get, so questions that the FASB gets, and others about, hey, how far does this data have to go out? That's a common question. How far do I have to go out with reasonable and supportable? The answer is, how far can you support reasonable? And that's probably going to be a shorter term than some people might think. It's probably more a couple of years rather than 10 or 5 or something like that. You focus on the factors that are relevant to collectability. Adjustments do not have to be macroeconomic in nature, so they don't have to be about, although, note, they do not have to be macroeconomic. You certainly can make macroeconomic adjustments. Acceptable forecasts, specific events, and one of the common things that they would talk about would, like, if there were a large employer in your area, in your market area, who has announced their closing, and there's going to be jobs lost, and that's a relevant portion of your customer base, and that there's other ancillary companies related to that business that will also be impacted. It's perfectly acceptable and encouraged to build such, actual real life, your market events into your reasonable and supportable forecast. I won't get off on reversion too far because it's a little bit tricky, but for periods beyond the reasonable and supportable forecast period, there is an option. So when you get past reasonable and supportable and you need to go further, there is the option to revert to your historical loss data, and that comes straight out of the standard in 326-20-30-9. You're permitted to revert to historical loss data. You may adjust it to differences in current asset specific risk characteristics, so that would go back to your pooling. You should not adjust historical loss information in the reversion period for future economic conditions, and you're not required to revert to use straight line basis to revert to historical information. They allow you to use straight line basis because it's the easiest. What they're saying here is you don't have to, but you can use straight line and probably would want to if you determined you need to revert to historical loss information, which may or may not be the case, and it may or may not be material and relevant for your institutions. But I won't get off on that. Okay. So the WARM method. So why the weighted average remaining maturity method? It's the closest thing to what most smaller, less complex institutions are doing today. And as a result, and this is my interpretation, it doesn't represent the interpretation of our firm. It represents, my interpretation is that the regulators were trying to give smaller, less complex institutions a practical way to implement CECL. And WARM is the closest thing to what you're doing today, and they thought it made the most sense for most banks. It doesn't mean you have to use it. It doesn't mean that it would yield the best result or the most accurate result for your institution. It just means that maybe it's the easiest and most practical, all things considered, and that you should consider it. There's no endorsement out there, but what you do have is you have the regulators, the FFIC, the joint regulatory body, emphasizing WARM. They went through it in pretty good detail in a webinar, and then you have the FASB putting out a staff bulletin and a Q&A on the WARM method. It's not an official endorsement, but it's about as close as you can get to an endorsement to not being an endorsement. So let's talk just a little bit about what the WARM method represents theoretically. The remaining life method utilizes average annual charge-off rates and remaining life to estimate the allowance for credit losses. For amortizing assets, remaining contractual life is adjusted by the expected scheduled payments and prepayments. So you do, under WARM, you do have to estimate within your risk pools, the loans within in your risk categories, you do have to estimate for expected scheduled payments and prepayments. You do have to take that into account. So that is an estimate that you'll have to make. The average annual charge-off rate is applied to the amortization adjusted remaining life to determine the unadjusted lifetime historical charge-off rate. That was a mouthful, and I'll show you how it works in a minute. So A, the average annual charge-off rate times B, which is the amortization adjusted remaining life, equals C, the lifetime historical charge-off rate. We've got a couple of slides where we'll go through this in a minute, mechanically, so you can see it. So what factors should you consider when determining whether to use the WARM method? How complex is your pool of assets? what is the contractual term of the pool? And let me stop here and say this. You can use different methods for different pools. I'm not suggesting you do it, but I would imagine that larger, more complex institutions, whatever method they choose to use, when you look at whatever Bank America is going to do or JP Morgan Chase or whomever, they're going to have a variety because they might have a pool of, whatever commercial, C&I loans, and they're probably going to dissect it a bunch of different ways, but they've also got a credit card portfolio out here. And so you don't have to use any one method, and you can use multiple methods. It just depends on what you think, would realize the most reasonable result for your institution and be most representative of your ACL, if you will. So what extent of the loss history is available? Are the losses sporadic with no predictive patterns? How many loans are in the pool? Does the composition of the pool vary significantly from historical pools of financial assets? So those are just some things to think about. Again, most smaller, less complex institutions, it's hard to say why you wouldn't use your report by call code just like you're doing today. Maybe you might have some outliers. You might have an outlying pool, but these are things just to consider if you're considering the warm method. So this is how you go through the mechanics of the calculation. And if you look down the left-hand side, it shows the amortized cost. Then A is the average balance within, across those years. And you're estimating prepayments and the other things we've talked about. Your actual annual net charge-offs. And then you come down to an annual charge-off rate. So it looks a whole lot like what folks are doing today. So you get an annual charge-off rate of 0.36%. Then you go over to the next slide and you go, okay, I'm going to apply. So based on that annual charge-off rate, using the weighted average method, we're going to project estimated paydowns. We're projecting the amortized cost of the loans and this isn't segmented. It's just putting them all in one bucket. And you apply the average annual charge-off rate and you get the 126. The 126 is what currently is your ASC 450 bucket as it relates to historical losses. So that's your historical loss bucket. You would then apply, which in this case is 0.9% of the balance on the general ledger. The qualitative adjustments are 0.25%. We don't go into that. We've been talking about those. The qualitative adjustments are the things that you adjust historical information for current events and reasonable and supportable forecasts. That's the 0.25. That's your qualitative factors today, except for the reasonable and supportable forecast. But mechanically, these two slides kind of show you how you would go about applying the weighted average remaining maturity method. And you would end up with 1.15% in your ACL, not your ALLL. But please understand, this is an example the FASB had, and questions they get like, okay, does that mean I have to have 1.15? No, it does not mean that. This is truly just a simplified example so that you can see theoretically how the warm method works. So with that, we have another poll question.
Okay, this is our final and fourth poll question for the webinar, and it is reasonable and supportable forecasts must be developed using external information. Is that true or false? So we'll give you a few seconds to answer that.
Must, not can. Must be.
Must be. And remember, you have to answer this question to get your CPE credit. So visually. So we'll wait just a second or two. But Doug, you've done a great job so far. So I'm thinking that we'll have a really high score on this one. So we'll close the poll and see how it turned out. Oh, great. So the answer is false, and 64% got that correct, with 36% thinking that was true. So thank you all for voting on that last poll.
Okay, thanks, Phyllis. So we've covered a good bit of ground. We've covered kind of where the regulators are, where the guidance is, the due dates. We've gone through and drilled down a little bit further than say last time on some of the key concepts, which includes reasonable and supportable, qualitative factors, and other things. And I think for most institutions that are our client base, it's no matter where they are in the process, it's kind of like, okay, well, what do we do now? How are we going to do this? We got 3 more years, and so I'm going to give you just some practical thoughts that are my thoughts, not the thoughts of the firm or anybody else. Just some things that I would suggest to my clients and non-clients to consider if you're a smaller, less complex institution. First of all, don't get caught up in the rhetoric. I don't see any way that CECL's not coming. I mean, could it be pushed out again? Potentially, sure. But do I think that, I mean, there's a path that's happening right now, and they deferred 3 standards yesterday. It wasn't just for private companies. It wasn't just CECL, the lease standard and one other one. It's escaping me right now. They delayed them. All 3 of those are principle-based standards, and they're to try to bring the U.S. system further in line with the international system, with IFRS. So there's a convergence. That ship is sailed, and it is going to happen. And might you get more reprieve than we have now? Might it get pushed out? That is possible. For me, I think that you can go through this exercise and you can improve your processes. And even if CECL never happened, the only piece that's different, if you really break it down to the most basic element for a smaller, less complex institution, the only thing that's different is the reasonable and supportable piece. That's the only piece. So there's an opportunity to improve no matter what happens with CECL. Don't presume you're going to be able to do what you've been doing under ASU 450 or ASU 310. You're not going to be able to. And so the reason I say that is, number one, I think your auditors are going to raise their bar because the guidance that they're going to be given and that we are being given is a higher bar. I think you're going to see that with your auditors. But what the regulators are telling us as well is that they're going to put their examiners through a CECL training process, and that when your examiners come to your bank, they're going or credit union, they're going to expect you to be on the CECL road, on the path to CECL compliance, and they're going to know what they're looking for. That is what they're representing. They're not going to be looking for a 1% reserve or whatever. They're going to be looking to see, are you complying with the standard? And I think they're outwardly representing that because in these documents that are being issued, but more importantly on these webinars, all the relevant parties are there. They're all singing from the same sheet. And I am expecting, based on their representation and the way they're going about it, that the regulators are going to be looking for you to be embracing CECL and not just simply doing what you've been doing. Another item, data is the new oil. Make sure you, and most people have probably done this, but make sure you're talking to your core provider and that you can get the data you need, or the other sources that might be out there. That drives what you're going to be able to do. And I've heard different stories. I've heard people say, hey, no problem, I'm with X provider, or I'm with X provider. They say, no problem, we can go back X amount of time. Then I've heard people say, hey, you can't go back more than X. We don't even have that data anymore. I don't know if that's true. Or we can't go any further back than X unless you want to pay us to go back. So make sure you have those conversations and you know what historical data you can get, because you're going to need that historical data. You're going to need it based on the way you plan to cut your loans, how you plan to group them based on risk. So make sure you're having those conversations. Third-party assistance at some level is most likely going to be necessary, but that risk and dependence needs to be managed. You don't have to engage a third party and run a model that a third party runs, but I think there's some opportunities here. As CECL has unfolded over this since 16, the price I have seen, in my view, and this may be contrary to what some folks on the call have seen, I've seen the cost coming down from some of the providers. There's been some consolidation into the industry. You had 3 providers that have been acquired and under one umbrella. My understanding is cost is coming down. There's some other providers entering the market that are more cost effective and simplified. And so there's probably a better opportunity to get with the third party. And that doesn't just include the third parties that would run your model. I'm talking about your advisors, the folks that provide audit services for you, the folks that you consult with. Maybe that needs to be somebody different. I know there's only so much your independent auditor can do. Maybe needing, look at other advisors, but you need to look at who are the third parties you're going to leverage. Go ahead and lock those in, because the closer we get to 2023, the less external resource is going to be available. There's only enough, there's only so many providers. They can only accommodate so much. And I, in fact, at the AICPA banking conference, one thing that was mentioned in one of the roundtables was, and these were folks that had to comply January 1 of 20. They were talking about how resources for them were shifting and how they ran into scenarios where providers that said they could do certain things were unable to do them when they said they could do them because they were taking on more clients. And the larger clients that were taking their time were getting more attention than they were. And some of them had to, there was one CFO that described having to basically change vendors in midstream because of that. So you don't want to be one of those folks. You want to determine who are the third parties I need to be engaged with and engage them early in the process and leverage them all along the way. The most success, and this is from one of the providers that gave an overview, their lens was the most successful CECL adoptions, both vendor and internal, have recognized it as a cross-functional challenge encompassing data, model, reporting, and process. So it's not just about the CFO, it's not just about the controller, it's not just about the chief risk officer, the chief lending officer, it's not just about the technology folks, it's about the team. And so the folks that have been most successful from this third-party servicer's viewpoint have been those that have embraced that idea that it's cross-functional, even in a smaller institution, and recognize that you could have multiple third parties that you rely on in different ways. So here's some things that I would emphasize for you to do along the CECL path. Identify internal ownership. Proactively communicate with relevant stakeholders and trusted advisors, which is part of what I was talking about then. So who's going to own it? And it takes a village. Risk segmentation. I would say identify reasons that your call report codes can't be used. I mean, people will say, oh, are you sure your call report codes? You need to look at that. Let's not make it any more difficult than it is. Why can you not use your call report codes? If you're a small community bank in South Georgia or South Alabama, why can you not use your call report codes? I don't know why you can't. There needs to be a reason that you can't, or there might be a certain segment there that you don't think is representative, or the data is not available for some reason. I don't know, but it's hard for me to see why you can't use your call report codes. That's a practical approach to me, and I think that let's not make it any more complex than it is. Again, assess data, determine that necessary data is available from your core provider or whomever else and wherever else you need it, and do that early. The decision between a third-party model or internal, you need to look at the warm method. I kind of look at that like I do call report codes. Why not use the warm method? You need to come up with a reason not. If you're a small institution, smaller and less complex, why would you not use the warm method? The regulators have all been endorsed it. It's the closest thing to what you're doing now. There are providers out there who have tools that use the warm method. I don't see why you wouldn't strongly consider it. You need a platform to clearly document assumptions and significantly enhance documentation of Q factors. As I mentioned earlier, there are platforms out there, there are third parties that are cost effective, and you could develop your own. I think you're going to need to enhance your documentation in and around your Q factors. They're going to have to be by loan segment, however you segment your portfolio. I think your auditors, your regulators, and all other stakeholders are going to expect that the Q factors will be better supported than they are today, even before you get to the reasonable and supportable part. But if you went through you can do everything using the WARM method. You can enhance your documentation. You can get the data, and you can use your call report codes. You can be doing that as you move towards 2023, where you have to bring in the reasonable and supportable. There's no reason you can't be moving along that path now. Don't forget about controls. If you've got a model and it's truly a model, the expectations of the controls and processes around how data gets in the model, how that data is protected, who has access to it, how is its integrity ensured, all those types of things that are probably less of a point of discussion with your regulators today or with your auditor today. I think they will be more of a discussion going forward. So identify ownership, determine why you can't use your call reports, assess data sooner rather than later. Go ahead and consider, third party or internal, but look closely at WARM, and then don't forget about internal controls. That would be my recommendation. Auditor expectations. I won't go through this, but there's an ACL. I mentioned it, the CECL Audit Practice Aid. It covers these 4 or 5 areas. I think your auditors are going to be looking at it. I would suggest you get a copy. I'll send you a copy if you email me. I would be looking at it for implementation purposes, particularly when you're looking at what is my auditor going to be doing, because this isn't coming from the PCAOB for public companies or the SEC. This is coming from the AICPA, which is gas audits, which is most everybody on this call has a gas audit. This is going to be what they're going to be your auditors are going to be expected to do. What is in this audit practice aid? And this is our broader roadmap, and you can get a copy of that off of our website in our CECL trends section. So with that, we are at 57 minutes, and we will open it up for a few questions if anybody has
any. Okay, Doug. There have been a few questions posted, and we'll just cover what we have time for. One that I thought was interesting that I wanted to know is it necessary for loan officers and other lending personnel to receive training on CECL?
From my perspective, the answer to that is yes. Now, would it be the same training that your CFO needs, or that your chief credit officer needs, or your chief risk officer? It might not be at that level of depth, and some of this theoretical stuff we just went over they might glaze over when you get to it. But if we're going to be recognizing losses day one, in theory, then there is there's a good possibility that as CECL, after 1/1/23, and as you move forward, I think institutions are going to find that they're going to be potentially lending a little bit differently, or structuring loans a little bit differently, or thinking about it a little bit differently, because we're not going to be using the probable and estimable threshold. We're going to be recognizing life of loan losses day one. And so I think it would be good for everyone to have some baseline understanding of CECL, even the non-bean counters.
Oh, thank you, Doug. You did a great job on this webinar too. I've said that before, but you really covered some good topics, good instruction that we all need. One other question I think we'll just take a quick minute to answer, if you could answer this quickly, is will the regulators expect a 1% reserve regardless of the outcome of the CECL calculation?
Yeah, I can only take them at their word, which is the same thing I said about their representation, that they were going to train their folks and that they were going to be coming in with knowledge of CECL from the FASB perspective, from the actual GAAP perspective. They have made it clear verbally that there is no predetermined outcome, and that there should not be a predetermined outcome. That you support what you do under the standard, and the outcome is the outcome, and they're going to evaluate how you got there, not where you ended up. And that is, again, that's their verbal representation. But if they truly train up their folks, which I believe they will, and they look at it from the appropriate lens, I do not believe that there's going to be any predetermined percentage out there. Well, time will tell, but that's not what's being represented today.
Okay, thank you, Doug. And then any question that didn't get answered, Doug would just email directly to that participant. But I just want to take a minute and thank everyone for joining us today. The next slides give Doug's contact information. If there's anything in the slides that you need to, well, even before that, also connect with us on social media. The slide before, like at CRI, CPA, a lot of the information as far as like future webinars we post on there and other current relative information. But on specific to today's webinar, Doug's contact information is listed. Feel free to email him any questions you have once you've had time to think about the material or anything else. Just don't hesitate to reach out to us. That's what we really like to do. And then also just upcoming webinars that you may find interesting. We have our year-end tax planning webinar that's going to be on November 7th. So we encourage you to register for that. It's for individuals and also one for businesses. So we invite you to those. I think it'll be very interesting and very helpful to you. So again, thank you all for joining us today, and thank you, Doug, for doing a great job on the presentation.
Thank you, Phyllis. Thanks, everybody.